Hey everybody, Steve here. Thank you so much for listening in. It's been a few days since I did an update, but I can tell you we are operating at top speed here at Ankerstar Wealth. Everybody hitting on all cylinders because we have new technology coming your way via Black Diamond. There's a few beta testers out there kind of helping us out with that right now to make sure that release is perfect for you. It's going to take more information about your portfolio, your financial plan, your risk levels, and put it right into the palm of your hand and your phone. If you never look at it, you won't hurt my feelings. But if you're ever sitting there wondering, hey, I wonder how I'm doing financially, it's going to be right here, and you can look at it and then ask a question eventually right within the app, a little chat within the app. So a lot of exciting stuff coming there. The market is basically screaming higher. The Dow is up, 12, 13 days in a row. Might be in the green today. We got the Fed meeting, so we'll see. Tech has taken a little bit of a breath as far as, running up. So the book is growing, your account should be growing. Tech took a little bit of a breather, but now we have earnings. So earnings, the beat with Google, Apple hitting all-time highs and offering some new technology. So a lot of stuff is going on. In addition, we have a client event coming up next week, our first ever virtual client event, which I'm super excited about bringing this to you. It'll be 6:30 on Thursday night. There will be another email and video from me, hopefully later today, if we can get to it, to get that information to you. But mark your calendar, 6:30 on Thursday, August 3rd. Dr. Mark Milstein is going to talk about brain health. Everybody, we talk about financial health all the time. So, but if you're financially independent, I say once you get to be financially independent, the only things that really, you think about primarily are health and wealth. Right. So this is kind of our first event to talk more about the health piece. It's like, hey, if you've made a bunch of good decisions over the course of your lifetime to get to the point to where, you're financially set, now it's how can you keep yourself alive the longest and your brain, productive the longest. So he wrote a book out there. It's called Keeping Your Brain Young, with the subtitle of Slowing Aging, Boost Productivity and Lower Your Risk of Dementia. We've all seen that to a certain extent. And, I'm over 50, so I forget, where the car keys and stuff are all the time already. So, right. It's just like, so let's keep that, let's focus on our brain and do everything we can, of course, to keep our brains healthy and lasting as long as possible. But that's not what we're going to talk about today. I owe you a market update. I'm a little bit overdue on that. But we're going to talk about three things today. There is a Fed meeting later today. So we are a couple hours out from an announcement. Are they going to raise? Are they not? We'll talk about that. We're going to talk about why the banks are on fire and great investment in Schwab and KRE that we made a little while ago after the big collapse earlier this year. And do they have more room to run? We'll answer that question. And the last thing we'll talk about is some of the Social Security updates. There is legislation that's being talked about to increase the age. So we'll talk about that. And we'll also talk about your Social Security cost of living adjustment, which is again tied to inflation. Well, inflation's coming back down. So that's what we're going to talk about today. Before we get started, standard disclaimer applies. This is not a personalized financial presentation. So you have to do your own due diligence for acting upon anything you hear in this presentation. More information is available at ankerstarwealth.com. Now let's get started. I'm sharing out CNBC here. Fed decision, what's going to happen? I would say this is the least forecasted Fed decision we've had. So let's rewind the tape. We had 10 in a row, largely 2020 into 2020, 2022 into 2023, 10 in a row. Took the short-term rate from basically nothing all the way up to 5%. For a move like that, it is a small miracle that we didn't see a more bigger impact on the stock market and or economy, right? Normally you have moves like that, you throw the country into recession. So far, we have not done that. At the last Fed meeting, the Fed paused. Again, we called that it was going to pause in the second quarter of 2023. So that happened, and I'm grateful it did. But then the commentary after that was, well, we may need a couple more rates, which was really not helpful. I did a show on that. It's just like, that gives us nothing, right? So I literally think I have a better chance of taking a coin out of my pocket or finding one, since nobody carries coins anymore. But if I could find a coin, I would flip it. And that's about where we are. I'm predicting whether we're going to get a 25 basis point raise today or not. I think technically the market experts, which you should run when you hear somebody say that, but the people who are out there say that there is a better chance of one happening than not. Here is my exact take. I think Chairman Powell and the team at the Federal Reserve have basically done a masterful job of navigating this. You could argue maybe they started late. I'm not going to nitpick it. I think they've been a literal championship team. They've done all these raises. They forecasted it to a large extent of exactly what they were doing. They finally paused. I think it would be a mistake to have another rate hike. I think we are where we need to be as far as inflation. You know, it was up at that 8-9%. It's been steadily dropping. It takes time for these things to take effect. The last inflation number we had was 3%. We're trying to get to 2%. It's been falling off a cliff. We're there. You won. You know, Team Fed, you won. You know, and I do like to play poker, and you know, for those that go to casinos and gamble, if you're up big and you've done everything right, you've won. Go home, right? So why would they get back involved and get fancy here with going in and raising 0.25%, which literally in the big picture makes no difference, right? And if they do raise it, I think you're going to see a lot of analysis of did you go from 0 to 5, and you think 5.25 is like really so important that you had to do that. So anyhow, my take against the system is that they're not going to raise today, but I am fully prepared to be wrong on that one. But maybe that's me being hopeful, but they don't need to. They've won the game. We could potentially have a soft landing where there's literally no recession. Come on, what more do you want? This has been great. The market's largely recovered. If you stayed aggressive, you're pretty happy with your portfolios. That's all I've got to say about that. We'll find out here in a few hours. Even if they raise, I don't think you're going to see much of a sell-off in the market. It's not going to be a heart attack moment either way. So that's what I expect. All right, let's move on to banks. Why have the banks been on fire? Well, it's called bank earnings. So let's back up a little bit. This is a one-year chart, and you're looking at the regional banking ETF. So history, right? We talked about the Fed and all these interest rate increases, and you're like, hey, banks love when you raise interest rates, right? It's like, well, they have a net interest margin, right? So wherever the Fed sets the interest rate, a bank's going to charge a couple percent more for loans and keep the difference, right? That's how they make their money. That's why small towns have 7 banks and 1 restaurant, right? So it's their bread and butter. So they kind of don't care. Here's the problem, and why we saw bank failures in the early of 2023 is when you raise interest rates, the value of stuff you have on your balance sheet changes. And some of you saw this. If you're in individual bonds, if you are in individual CDs, you could see them drop in value. If you have it with the bank, you don't see the value on a daily basis. But having your brokerage account like Schwab, you'll see that they actually drop in value because of that higher interest rate, meaning folks can move in for the higher interest rate and not buy what you already have on the books. So it's a mark to market sort of thing. But yeah, that's what took Silicon Valley Bank out. They had all these assets that they thought were worth this. All of a sudden they had to reset the value to this, and then they went under. Signature Bank, there were a handful of others that went under. Well, when that happened, this ETF, like you can see there, when you see the waterfall in, what is that, March 9th-ish, that week or whatever, where it sold from 65 down to 45, right? So what's that? Rough math, 30% drop. Maybe that's a little off, but huge drop. But then the question when you see a huge drop from an investing perspective is this an opportunity or not? Sometimes things can drop 30% and it's a clear sell, right? It's like, whoops, should have sold it earlier, didn't, have to own it, and have to own up to the fact that I missed the sell and sell it and dump it because it has no future, right? In this case, when you're talking an ETF of regional banks and it drops by 30%, there's one question. What's the future of the regional banking industry? Is it fine and we're weeding out a few bad apples? Or is it a hot mess and about to implode? Well, I made the decision with the team, we talked about it, and it's just like, hey, we think regional banks are fine all in all. So we loaded up on KRE. We went in and we looked throughout all the big banks. I don't invest in individual regional banks. But because I like to stay more best of breed. But when I look at around the big banks, I'm like, which ones do I want to invest in? And I'm already in JP Morgan. I have some Bank of America in the book. Basically, we landed on Schwab, and both have done a fantastic recovery, made a bunch of money over a short-term period of 3 or 4 months. Didn't happen overnight, right? So it took a little while. And then what's the question is, well, when do we sell? Well, I'm going to let it run for a little bit. Bank earnings have been amazing. There's 22 large banks, and I think all 22, or there's 21, passed their stress test. And these stress tests are no joke. I mean, they're not just eyewash, right? They're legit hard tests put in place to make sure banks are stable, and our banks are stable. So I'm not worried about it. So anyhow, you see, get a 3% dividend on this ETF while you wait. I'm going to let it run up a little while, probably not to new highs. I'm not going to get greedy, but yeah, certainly I think, the KRE here at 49, it could run straight up to, mid 50s, high 50s. And then at some point in time, you have to go, okay, we've won right on the trade. So we're going to get rid of it and move on to something else. All right, last topic for the day. A lot of you are in the Social Security collection phase, or you're wondering what's going to happen. Is anything going to be left? Well, something has to be done. That's for sure. If you are my kid's age, you're dialed into this at all, you're like, well, this seems like a hot mess. Why am I going to get anything, or I just won't ever plan on it? Well, as these things go, though it'll be adjusted, obviously, to keep it alive, but you'll probably get less and less over time. If you flash back to pensions, that was you either went to college or didn't, but you took a job out of, your tech school or out of college, and you worked for the same company for 40 years, and then you got a watch and a pension, right? That's not happening. Well, then you moved into you don't get that anymore, but you get your self-funded 401k, TSP, 457, 409 alpha, whatever you want to put money away. And then you grow that, and then you have Social Security kicking in sometime in your 60s, right? Well, now that is challenged, right? We still got all the self-funded 401k stuff, but Social Security may be kicking in later. The exact legislation that may gain some traction is taking the full retirement age from 67. Again, your full retirement age for you as an individual is different. You have to go onto the internet and look it up, right? Because it changes. And if these things get phased in over decades, and so you kind of have to go in and look yours up. But if you're younger than, I don't know where the cutoff was, maybe 40 or so, you're looking at 67 as your full retirement age. Well, there's only so many ways to save the system, right? You can collect more, you pay out less, you pay out later, all those little tweaks. Well, the one that's on the table now is taking that full retirement age from 67 and moving it to 69. And the thought is, well, we're living longer, we're healthier longer. I think that's true, but provable. And then so you have the capacity to work longer. That's probably an interesting argument. If you work the full retirement age working at 67, yeah, I could see that. 69, I mean, there is a number where, for the most part, you'd like to step away from the workforce. So I think this could happen. I really do. I think it'll be a, standard food fight with Social Security, but I do think that it's going to slide to the right. If they move it to 69, they will take like all of us that are over 50 or 45 or something, and we'll be grandfathered into our own number right now. So it really only affect, folks that won't be collecting for 20, 30 years. It's kind of a, pass down the bad plan, if you will, or whatever plan you have onto future generations, which we've done in several cases, kind of unbelievably so. But that's what I would expect, and then it'll be phased in, right? So there will be somebody out there that has their full retirement age is 68 and 1 month, right? So more to follow on that. Last one I'll talk about is this cost of living adjustment. A couple years ago, I think it was 5.8. This past year, it was 8% and change. This coming, so you get used to that, right? So you're like, oh, I'm going to get this big raise for Social Security. Well, historically, I don't have the 50-year chart, but it kind of runs up, with the 80s. It's tied to the cost of the CPIW. And, it runs up big when inflation is, but then also after that, it can be zero for a number of years. Well, it's not going back to zero because we still have inflation. It's down to 3%, but that is the exact prediction that, again, quote unquote experts, so carefully listen to, but I think it's about right. Say that we're going to get 3% this year. It'll be announced in October. I'd say really it's anywhere from like 2.7 to 3.3. I think that's pretty accurate of what you're going to see if you're counting on that sort of stuff. Most of the folks I deal with, it's kind of nice to have Social Security coming in, and a little bump is better than nothing. But again, not generally a game changer to what they do on a daily basis. So, all right, that's all I have for you today. Thank you so much. Remember, mark your calendars for next Thursday, August 3rd. Dr. Mark Milstein will be talking to us for 45 minutes over Zoom. It'll be a must-attend event. We will have the replay out and about afterwards, but really having you there live and listening to him real time, he'll take questions. So really excited about that. And with that, we will talk to you next time. Bye.